Hey everyone, thank you again for joining us today. My name is Riley Anderson. I'm the Marketing and Public Relations Manager here at The Retail Coach. I'm joined with Austin Farmer, who is a Project Director at The Retail Coach. We're very excited that you're with us today. Just wanted to go over a couple of housekeeping notes again before we get started. If you have any questions or need anything throughout the webinar, you can put it in the chat or Q&A box. I will be keeping an eye on that. Also, this webinar is recorded, so the slide deck and presentation recording will be sent out later this afternoon. Again, we are happy to have you on today, and let's get this started, Austin.
Awesome. Thanks, Riley. Thanks for joining us, everyone. Just to reiterate, if you have questions during the webinar, please feel free to add those to the Q&A box, and Riley will feed those through to me. But appreciate you joining us. We wanted to have just a quick webinar to talk a little bit about the retail trends that we're seeing right now. Really kind of how coming out of COVID, the retail industry has adapted and reacted, and then talk a little bit about where we're going for the coming year and really how that impacts communities. What we have tried to do on these webinars, because we know time is so important these days and everyone has a little bit of Zoom fatigue, is we're going to stick a little bit more to the high level trends today. But anyone that registered for the webinar will be sending out some more detailed slides that have some graphics and examples for specific retailers that we reference on there. But we're going to try to have kind of a 35 minute run through of this presentation just to make sure we're not taking too much time, and then we can follow up with some specific examples if any of those stand out to you, or there's some data that we can provide that would be helpful to you. But for those of us that are joining us for the first time, as I mentioned, my name's Austin Farmer. I'm a project director for the Retail Coach. I manage all of our projects on the West Coast. So anything that really is in the Southwest or the West Coast, I manage those projects and help set the strategy for coming in and doing market analyses for communities and helping recruit new retailers and developers to our client communities. As a company, the Retail Coach, we have over 20 years of experience. Our founder, Kelly, started the Retail Coach back in the year 2000. And so we've seen the shifts and twists and curves of retail over the last 22 years now. We've worked in over 650 client communities in more than 40 states. And over the last 5 years, we have been successful in recruiting more than 6 million square feet of new retail to client communities. And we work with a lot of statewide and national organizations like International Council of Shopping Centers, International Economic Development Council, League of California Cities, Texas Economic Development Corporation, really to focus on how communities and chambers of commerce and cities can go and focus on new retail opportunities and really maximize where there's retail opportunities in their community, and then go get those retailers to come in. And so really our focus when we work with clients is figuring out where there's retail opportunity and then going and recruiting new retailers to your community. Part of that on our end is really understanding what's happening with the retail industry and what shifts and changes and evolution is coming into the retail market. No surprise, COVID has really accelerated some of those changes that we've seen over the past few years, especially in brick and mortar retail. But we're starting to see some of those kind of solidify and start to shape out how retailers are either expanding or planning to expand over the next few years. And wanted to talk about some of the top retail trends that we've seen and that we think are important to keep an eye on, especially if you're a city manager or an economic development manager, economic development director, chamber of commerce. If you're focused on retail in your community, I think it's important to at least know that these are happening. And we're going to focus mainly today on what we're seeing now. And so the top trends that we're seeing now for the retail industry, first and foremost, are ever-changing consumer behavior. No surprise that coming out of COVID and the pandemic, a lot of consumer behaviors have shifted and a lot of their expectations have changed just based on the rise of technology and integration of online, offline shopping. Everything down to the hours that people are shopping or eating is changing. The second one is that retailers are continuing to right size. If you haven't heard the term right size yet, get ready, because that's the new retail buzzword. I think we've officially shifted over from retail apocalypse being kind of the core retail buzzword to right sizing, or retailers right sizing being kind of the key buzzword for the industry. And that's really just retailers looking at their current store fleet and looking at ways to optimize their stores, downsize a little bit, become more efficient. So we'll see a lot of that over the coming years, and we'll get into some specifics in a second on those. The third one there is challenges for restaurants and the evolution of full service dining. I think of all the retail categories that we work with outside of probably movie theaters, full service dining has been the one that has had the biggest challenge coming back from COVID. And so we're going to look at a couple of challenges there, and then the evolution of how that's shaping dining and where that's going. That fourth trend that we're seeing is more cautious expansion. So retail expansion that makes sense. And what that means from our perspective and what we've seen from the retail partners we work with is, there was this buildup from 2016 to really 2020, where retailers were starting to expand a lot more rapidly and get into new markets. And so we've seen them pull that back a little bit and really focus on expansion that makes sense more strategically than just trying to get into new markets. So we'll see a lot more of that cautious expansion. The good news there is we're not seeing as many retailers as we thought we would completely pull back on expansion. There are a lot of retailers that are back to their pre-pandemic expansion plans, or some have even exceeded that. But how they're doing that has kind of changed, and what markets they're looking for has changed. It's also created a lot more opportunities as well. We'll talk about some of those. And then the last one is meeting demand. So retailers trading down and opportunities for discount retailers. And what we're seeing as we get into 2023 with recession looming is that we're going to see a lot more price conscious shopping. And so a lot of retailers are starting to look at that and figure out how to incorporate some of those discount options into their brands. And we'll talk about a few of those. So the first trend we're seeing is those shifting consumer behaviors. And so again, no surprise, the pandemic and then the changing economy, the looming recession we keep hearing about coming forward is driving some shifts in consumer behavior. And so the first one that we've seen within that is that consumers are making shorter and more frequent visits to grocery stores and superstores. If you're anything like me, that makes a lot of sense. I've gotten to the point where I only go buy what I need for about a week at a time. And I think I go to the grocery store 4 or 5 times a week now and just get what I need and just run in and out in 15, 20 minutes. But that's something that's really been shaped across the landscape of retail, and particularly for grocery stores and superstores, is that, consumers have gotten used to being able to come in, get what they need, leave, and they're okay making 4 or 5 trips over the span of a month instead of just saving up and going on a weekend and getting everything that they need. So that's something that's going to be interesting for how these stores react to that, particularly with online shopping continuing to grow and pick up in store. I think some of that has contributed to some of those shorter visits. You can just log on, actually get something online, buy it, and then just go pick it up at the store. And so people are doing that more frequently. But that's something that retailers are looking at in how they set their store up, what that means for distribution, especially with the integration of online and offline. If you've been in any superstore recently, Walmart, Target, even the Costco's and Sam's of the world, now is that most of their store is set up for a mix of in-store purchase and distribution. And so we've seen that shift a little bit over time, but most of those major stores and discount stores and grocery stores are starting to look at their stores more as distribution hubs than just a standalone store. And so that'll continue to shift and shape as they figure that out. A couple of the examples that we've looked at there is the grocery segment. So we have a partnership with a group called Placer.ai that does cell phone data. They measure consumer cell phone data to tell how many trips people are making to certain stores, when they're leaving the market, where they're going. And then they track everything down to how long visitors are staying at retail stores and shopping centers. And we looked at some of their data, and particularly for the grocery sector, their store visits are actually up quarter over quarter for the fourth quarter, 6.8%. And that has actually gone down a little bit. In the third quarter of 2021, they were up 7% in terms of just average visits per venue. And before that, in the second quarter, they were up 11%, meaning that people are coming to the store more often. But when you compare that to their actual visit duration, visit duration has been down at least a few percentage points every quarter. And so for the fourth quarter of 2021, even though they had 6.8% more average visits per venue, their average visit duration was down almost 4% to 3.6%. And so that's something that we're watching to see how that really translates across different retail sectors, if that translates into sporting goods and clothing and some of these other discount type stores. But we've seen that at the grocery segment, and then at the superstore or larger store format, we've seen that with Target. So Target over the last 12 quarters has seen a gradual decline in their median visit. So it's now actually dropped under 30 minutes. So the median visit duration to a Target store used to be up in that 35 to 45 minute range. That's actually dropped below 30 minutes now. And their visit frequency has actually increased by about 50%. So it's gone from 2.6 visits per month to 3.3. And so that's something that we're starting to see in the data. And that's very interesting just from a consumer trend perspective of how that translates to retailers reacting to that, or how it changes store formats. We're not sure exactly how that translates to existing stores yet, but I've talked to a few retailers that say, hey, we're more aware of this. We're actually incorporating some of that data into how we look at our new store expansion, because we know the data, that's what people are buying, what they're coming in for, how long they're staying, what parts of the store they're staying in. So that really could play into some of the right sizing that we're seeing, where stores are coming in and instead of 120,000 square feet, they might have 90,000 square feet that's optimized for quick visits, and it carries primarily the top items that people are coming in and getting and leaving with. And so that could have a big impact on that right sizing and really some of those expansion plans. That second point there is increasing competition in key segments. We're starting to see some increased competition across some key segments and a lot of cross shopping between different types of retailers. And so that's something that has really played out a lot more over the last couple of years. That's something that's a good thing and a bad thing, because it helps create more synergy with shopping centers. So if you have an anchored center that has a Walmart in it, for example, and you get more cross shopping with some of the other tenants in town, that can help with that retail synergy and really help the market overall with better performance. That's also due to a lot of new players coming into the market. One of the challenges for fast casual and full service restaurants has just been the swell of the amount of concepts that have come into those key segments. So that's something that is really changing how those retailers are looking at certain markets and certain regions, certainly the West region, primarily in some of those dining segments, as well as some of those superstore segments. There used to be a lot of markets that Walmart was in that Target wasn't. And we're starting to see that with Target's expansion over the last decade, you're having a lot of that competition in those markets. So that competition is really driving some of those conversations on market expansion, even some market retraction, and then creating new opportunities for smaller markets. So Target has actually looked at a few smaller markets more recently and mid-sized markets. And I think the key takeaway there as a community leader, whether you're economic development managers, city manager, economic development director, that's a good thing in the sense that it's creating more opportunity for mid-sized markets that typically weren't considered large enough to have some of those retailers, because they're looking for markets where they're not going to have as much competition. And so that could be a good gateway for some of the on the bubble communities that maybe your trade area is at 80 or 90,000 and not quite across that 100,000 threshold. We're starting to see some of those bigger retailers that used to demand a larger trade area, larger market, come back to some of those mid-sized markets or those bubble markets where they can get an advantage of being a first mover there and kind of beat the competition to that market. So that's something to be looking for. We've already seen that with Walmart and Target and some of the larger retailers of the world, where they're actually considering markets that even just 4 or 5 years ago, they had said, hey, these markets are probably too small for us. There's not as much traffic as we'd like to see there. One example of some of the cross shopping and competition there is Walmart. So we've seen their customers cross shopping with 5 other discount retailers, primarily Big Lots, Family Dollar, Dollar Tree, Dollar General, and Five Below. And so that change is important because it highlights that there's not as much loyalty to some of those brands like Walmart as we once thought there was. And so that creates that opportunity, that competition to drive that synergy. It also creates opportunities for markets that already have some of those key anchors, but don't have some of those other cross-shopping discount brands. Those are some brands that we like to go in and target if they're not already in that market, because we know that that customer is shopping across all of those brands. So that competition ends up being a good thing. We have yet to see how exactly that's going to change some expansion plans and targeting plans, but the opportunities I think are great for some mid-sized and smaller communities to go out and get some of those retailers that are looking to take advantage of that competition or to avoid that competition. The third one there is that dining times shifted over COVID, and at least some of those are here to stay. So dining times have actually shifted based on the availability of delivery for orders. A lot of people are actually eating dinner later in the day. And so we're starting to see that those existing patterns of peak dinner, breakfast, lunch times are starting to change across those different segments. And restaurants are starting to react to that. And so I think the most logical application that that's had in the market to date is that you'll see a lot of restaurants staying open later. A lot of restaurants are starting to extend their hours to 10 o'clock or after 10 o'clock in the evening, because there's a lot of people that are eating later. They're also opening earlier. Some are having 24-hour delivery available and keeping their kitchens open. So that's one of those that we're watching in the fallout of COVID and really the recovery of COVID is, okay, how are our dining establishments and restaurants shifting to those hour changes? And a lot of that ends up being really just kind of meeting the customer where they're at. So most of those restaurants are having to look at that and say, okay, we may need to stay open later. We may need to increase our availability. We may need to have longer delivery windows, even extended delivery timeframes and geographic areas. So we'll see that play out across the dining sector. But that's something that we found interesting is that how those times are shifting across that different segment. And the last one there is consumers want stores that are more than just stores. So shoppers are looking for personalized, efficient, and sustainable shopping experiences. And so we're starting to see retailers react to that and starting to see them push for a more personalized experience. A lot of that goes back to the integration of apps and online ordering and how that plays into brick and mortar retail. But we're starting to see them really try to build community around the shopping experience and build in those components of being able to have the same experience online as you do in the store, and then being able to bolster those experiences in the store with some of that technology. I think the good thing that we've seen there is that hasn't pulled away from the brick and mortar investment from the retail side. It's actually driven more investment into existing stores and the build out of new stores of how they're going to engage the community, engage that shopper. So we're starting to see that play out a little bit in terms of how they're shaping those stores and really starting to engage with that customer. That's something that we'll see come out in those expansion plans as well, and really start to come into the right sizing of those stores. But that's something that we're looking at in terms of how does that play out for those different retailers. There's a couple of examples of that I think are interesting. The first one is Bloomingdale's. So in August of last year, Bloomingdale's opened its first small format store, and it's called Bloomies in Fairfax, Virginia. And it's really focused on creating a service-driven experience. And they say it's designed for discovery. So that's where customers can shop. They can actually eat, so they can get some food or grab a coffee or a cocktail. They can meet with a stylist. So it's very much personalized to their experience. They're one of the first that has that. Nordstrom tried that a few years ago with kind of a more modernized local experience with smaller format stores called Nordstrom Local. That didn't take off the way that we thought it would, but Bloomingdale's is really looking at that. We've also got Dick's Sporting Goods, who's looking at experiential stuff. So they're really trying to expand their experiential footprint. They actually have opened a few different experience-focused stores. They actually opened one in September of 2021 called Public Lands. And that's more of a concept store. It's focused on outdoor experiences more so than just the gear. It's focused on the experience of getting the gear, engaging with the community, engaging with the outdoors, all in one place. You can do product demonstrations in the store. And so we're starting to see that become a trend in terms of how retailers are incorporating that. So that's something that we're really keeping an eye on for that expansion or new concept phase of the retailer expansion, saying, okay, how are they using that data? How is that changing their stores? What does that ultimately mean for the community or the shopper? Does it change their overall market needs? And again, how does that create opportunity? Because there are a lot of opportunities that present themselves with some of those new concepts. The next trend that we're seeing is that right sizing that we talked about. So retailers continuing to right size. One of the key aspects there, I mentioned it before, but I think that's really going to be the key retail buzzword for coming years is right sizing. And really what it is just optimizing their store fleets. So it's really focusing on how do we take our existing store footprint and our expansion plans and optimize them to be as good as they can be for what we need to fulfill our customers' needs. So a lot of the retailers of the really large retailers of the world have overexpanded. So their stores are bigger than what they need based on shoppers' consumer behaviors. They have too many stores. A lot of retailers are carrying some stores that are either underperforming or they don't contribute to the bottom line. So we're starting to see them close some of those underperforming stores. The good news with the right sizing is we're not seeing as many of those retailers pull back on expansion. We're starting to see them get away from stores or markets that just haven't been there for a while, or that they might have been considering in tertiary markets. But for the most part, they're still continuing to expand at the rate that they had pushed for pre-pandemic or close to that. But what has changed is how they're evaluating those markets. So they're starting to look at smaller, more efficient footprints and doing more with less. So they're actually open to some smaller mid-sized markets that they weren't before, like I was mentioning with Target and Walmart and some of those larger brands. But they're also looking at it as more data. So how can we fully understand the market before we go into this market? Do they have the right consumers? Cell phone data has become a lot more important because we've been able to really overcome some of those hurdles and prove that market's there based on leakage, that overall consumer behaviors in specific markets, and really proving out trade areas. So as they go through that right sizing phase, I think there's a lot of opportunity for communities to focus on, okay, where's there opportunities for us to get in front of retailers that might not have considered us before, or even restaurants as well. Part of that comes down to the physical infrastructure. A lot of full service and fast casual restaurants that we're working with have downsized their site requirements. I'm actually working with a couple of full service restaurants right now that used to require 2.5 acres for the building and parking. And they're now looking at sites that are at 1.5 acres, or even in some cases 1 acre. So it gives a lot of opportunity if you have land available in your community. If you've got a 4 or 5 acre site where you could previously maybe have 2 tenants on there, you can do a lot more with that now because you've got retailers and restaurants looking for less space. They don't need 15, 20 acres anymore. They're going for 10 acres. Some are going for 3/4 to 1 acre pad when they typically went for 1.5 and up. So there's a lot of opportunity that presents itself in that right sizing, more so than just retailers scaling back. I think it's an oversimplification to say they're just scaling back and not expanding anymore, when in reality, they're just looking for expansion that actually makes more sense. That next trend that we're seeing is the evolution of full service dining. So no surprise to anyone here, dining is one of those category segments that was really impacted by COVID and that has had to really look in the mirror and say, okay, how do we keep up with demand? How do we get back on the track that we were on and really engage people to come in? They've had that longer road than most retail categories coming back from post-COVID recovery. A lot of those famous, well-known restaurants that we all grew up with or have known for the last few decades, some are probably not going to make it. Golden Corral is one that we've lost in a few communities recently just because they couldn't get people back into the store and were basically shut down for about 2 years, 2.5 years. Some of those others, the big brands like Darden of the world, are starting to get back on track, but we're starting to see where there's some changes that they're making to either become more efficient or to be able to future-proof themselves in a way that they can count on delivery more so than just in-person dining. They're changing their hours up some to account for the fact that people are eating later, having experiences later. One thing that we've noticed with this category, and is particularly in the Western states that we work in, and really in California, is that the category's been lifted by coffee and bakery. A lot of the coffee and bakery concepts did really well during COVID, and that's boosted their expansion plans and their opportunities. They have a lot of cash right now. Their revenue was really strong. And so we're starting to see that category has been kind of carried by those coffee and bakery concepts. I don't see that going anywhere in the next 4 or 5 years. One of the retailers we work with a lot is Dutch Brothers. And they were, from our perspective, one of the really big winners of the pandemic because they were able to really build that cult following they have and expand into a lot of markets nationally and really a lot on the West Coast. But they're still looking at expanding as quickly as possible. And they're getting into markets that they previously couldn't get into that may already even be saturated with Starbucks, Dunkin' Donuts, Panera Bread, all those bakery concepts. But that category's done really well. I think that category is still going to do pretty well over the next 4 or 5 years. I don't think it's fully saturated yet. I think from a community perspective, though, and an economic development perspective, if you have Starbucks, Dunkin' Donuts, Panera Bread, independent bakeries and donut shops, if you feel like you're at that saturation point, I would say be careful. It's always easy to get sucked into the trap of saying, hey, yeah, we want to bring new retailers and restaurants to the market. But that's something to consider from the long-term economic development perspective is, do we need another coffee shop? Do we need another bakery concept? It's great for communities that may only have 1 or 2 or that don't have that full slate of bakery and coffee concepts, but be careful with that because if you already have a handful of those in a community of 50, 60,000, it may not be worth adding another one. You're really not helping boost anything. It's just kind of splitting that consumer base. So something to think about there because I do think that category is going to continue to grow pretty quickly over the next 4 or 5 years. The other one is gas prices may change how consumers dine. Along with those shifting hours, a lot of people are looking at the gas prices currently, particularly in Western states. They tend to be a little bit higher, and then focusing on, okay, it's already going to cost us X amount to go out to eat for the family. If the restaurant's 15, 20-minute drive, we're going to pay for gas there. And on the way back, we're going to sit in traffic. So that's really changing a lot of the thought behind some of the expansion with dining in terms of, okay, how do we get people here knowing that they've gotten used to having things delivered, they've gotten used to a better customer experience, and now we have the economy as a challenge because they don't want to drive everywhere if they don't have to with gas prices going up. So we're starting to see some retailers factor that into their approach. The way we've seen that the most recently is just investing in delivery opportunities and even pickup opportunities. If someone's coming home from work, they're making that drive anyway, being able to optimize that drive for them and catch them either to or from their drive home to work. That's something that we're seeing there is just delivery investment and then optimization of, hey, let's save people to drive, or let's make sure that we can make it as easy and as fast as possible to get our food so they don't have to drive or sit in the car for a long time. I don't think that's going to be a long-term drag on dining. I think that's something that's a little bit more relevant just given the current economic situation, but something that retailers and restaurants are actively considering, given that could be something that factors into the next 1, 2, 3 years of how consumers dine. The next one there is, again, right sizing of full service restaurants is actually proving its worth. A lot of the full service dining concepts that have started to right size or have started to look at smaller footprint stores are really starting to see the economic benefit of that. They're not really losing any traction. So their average visits are staying pretty much the same or actually increasing quite a bit. And they're starting to be more efficient. So their overhead goes down because they don't have as much store that they have to staff. They don't have the physical infrastructure costs for having that larger store. So that's something that we're seeing and really think will play out over the next couple of years is full service dining, not being in a 10 to 12,000 square foot restaurant, but really getting that down to 6,000, 8,000 square feet leveraging things like patios and easier to service physical infrastructure. But that's something that I think is an opportunity point for a lot of communities of being able to get some of these larger format full service restaurants onto smaller sites than they typically would have looked at before. They're also looking at synergy along with that, with the right sizing of, okay, who could we co-tenant with in a shopping center, or if we have a pad, is there an opportunity if we have a larger pad that we need to bring a co-tenant in ourselves or develop something out ourselves. So there's a lot of opportunity that I think comes with the right sizing, particularly on full service dining, where you're really seeing a cut down from 10 to 12,000 square feet down to that 6 to 8,000 range. That doesn't sound like much, but that's a pretty significant footprint reduction. And I think there's a lot of opportunities there, not only just on how that works co-tenant wise, but for specific markets. If you don't have those larger pads, I think there's an opportunity to activate some of those smaller pads that can be a little bit more efficient for them. And that last one there, omni-channel dining might be the future of eating out. We keep hearing about omni-channel across retail. That basically is just the integration of all those different channels, from online, offline, every aspect of that consumer experience, just being able to provide an experience across every touch point of the consumer journey. And so we're starting to see that with dining, of all the technology integrated into it. We're starting to see drive-through only locations where you don't actually even talk to anyone. You order online, come pick it up at the drive-through, and you may not even interact with a single person the whole time. But that's going to continue to play out in that full service dining spectrum, as well as how we've seen that play out with quick serve and fast casual. So I think there's going to be a lot more integration, a lot more innovation there too, with how full service dining restaurants are focused on how they can cater to that potential diner across all those different channels. Our last trend here is that more cautious expansion. So I've talked about that with some of the right sizing, but really focusing on more cautious expansion across the retail spectrum. They're really being more cautious about markets they're going into, about specific developments they're going into, even in sites that they're going into. You've probably seen this in your community. If you've had a prospect looking at your market, a lot of retail prospects are actually purchasing their retail now instead of leasing it, just to offset the risk of going into a new market. They want to capture that real estate and be able to have an asset along with going into that market. So they're really starting to look at how they can offset that risk and really make the right decision on those markets. And then that second one there is they're looking for new opportunities that align with that right sizing and that overall expansion for the next 3 to 5 years, knowing that there's economic challenges out there. So they're really in risk aversion mode in terms of making sure that they're making the right decision on certain markets. I know we have some of our clients on here. It's frustrating to go through that process. I know we've walked through it with you. We have a few retailers that have been evaluating a market that they've wanted to expand into for probably a year and a half now. And so we're starting to see that already long timeline can get longer because they're going through and really making sure that they understand the market, understand the opportunity, really are doing whatever they can from a pro forma perspective to be as efficient as possible, and then making sure that they're not overbuilding or overdeveloping on those markets. And we've already seen that kind of shaping how their expansion is playing out, certainly how their market evaluation is playing out. But again, I think there's new opportunities with that, as well as just the challenge of that restriction or that longer timeline of actually expanding. I think there's an opportunity to get in front of retailers that are looking for those kind of hidden gem opportunities, or looking at smaller markets that all of a sudden make sense because their footprint and their pro forma has been reduced a little bit. So there's definitely some opportunity there to get in front of those retailers and to make that right sizing be an opportunity instead of something that ends up being more of a challenge. So that next trend that we're looking at is discount retail. So retailers trading down to meet demand. And really what that means, that trading down to meet demand, is retailers are starting to incorporate discount options for those price conscious consumers, especially now with, again, a looming recession in the pipeline or on the horizon. There's opportunities there for discount retailers discount retail did really well in the tail end of COVID and really through the post-COVID, really the last year. We're starting to see more opportunities for those discount retailers, the TJ Maxx's, the Marshalls of the world. We're also starting to see a resurgence of some of those that had died off throughout COVID. Tuesday Morning is a great example of that. I think Tuesday Morning is going to start to have a pretty strong recovery. We're starting to see an uptick of traffic to their stores. But in terms of how existing retailers are really kind of trading down to meet that demand, a couple of examples of those are Macy's. So Macy's has stores that have what they call backstage, or an off-price shop within their Macy's shop. So they have kind of a discount brand like Nordstrom Rack for Nordstrom, but their backstage concept is really kind of discount oriented. It's focused on the off-price consumer that wants to save money and is price conscious. And actually in the New York market, Macy's stores that actually have the backstage concept in them are outperforming the stores that don't have it in there. And so they're capturing a broader audience, and they're actually getting more sales out of that because they have the discount option on top of some of their full price stuff. And so we know they're looking at that, figuring out if there's a way to incorporate that, or to even just through pop-up shops, be able to have some of the discount options in there. And we're really starting to see that across the board. Discount and off-price apparel overall has been really strong throughout the last probably year and a half. We saw a big boost over the last 12 to 18 months in the amount of traffic that has gone to some of those off-price retailers, really the discount retailers, the apparel retail. But when you look at those compared to traditional apparel and retail stores, the off-price apparel has been outperforming specifically over the last 12 months. They're seeing more foot traffic to their stores. Their sales have grown at a higher rate than revenue. So we're starting to see that trend is going to carry through, especially with having some fear and anxiety about where the economy is going. The key there for communities is looking at where there's opportunities for that, whether it's with existing retailers, just engaging them about the opportunity to incorporate some of those components of the off-price brands that are under their umbrellas. If I were in a community that had a Macy's, I would engage them about the backstore concept of either incorporating that into their location or even looking at available space that they can open a concept like that. Same with Nordstrom or Saks Fifth Avenue. With the Nordstrom Rack concept, we're starting to see that grow, and they're looking for more markets and more opportunities. The Saks Fifth Avenue concept, or Saks Off Fifth, is their discount option. We've seen them be able to come into some large footprint square foot spaces that were previously, whether it was discount department stores or department stores, but they can backfill a lot of square footage and basically have sort of a warehouse store there. So we're starting to see a lot of opportunity for those. And if you have those existing retailers, I would engage them about that and say, hey, we think there's a great opportunity to really build off that and capture some of the price conscious shoppers, especially as the economy is evolving and changing and people are a little bit worried about where it's going. But we're starting to really see that integration more. And I think there's plenty of opportunity with the big discount retailers. We've done more TJ Maxx, Marshalls, Ross's, dd's discounts in the last 5 years than we have in company history. And they all have pretty rapid expansion plans. So if you're in a market that doesn't have one of those larger discount focused apparel retailers, there's a lot of opportunity to really focus on those. I think now is the time to get in front of them because they are looking at the next 2 to 3 years of where that expansion is coming from. And then there's a lot of discount based or discount focused online based retailers that are starting to expand into brick and mortar stores. We saw that with TJX and Sierra Trading Goods or Sierra Trading Supply. They started actually opening brick and mortar stores. They've slowed those down a little bit, but there's a lot of opportunity coming out of the digital space as well with things like Backcountry and Steep and Cheap and a lot of discount retailers that are online only right now that are starting to look at how they can incorporate brick and mortar. So there's definitely some opportunity there as well. So those were the key trends that we wanted to highlight and talk about in terms of really where we're seeing the retail world go right now, specifically for Western states. I'd love to open it up for Q&A. I think I ran a little bit longer than we were shooting for. But if you registered, we'll send along some more detailed examples and some highlights of these trends, just with some practical takeaways. So don't worry if you didn't catch all of the notes on the slides. We'll send you some detailed information on the trends. But happy to answer any questions for the next 5 or 10 minutes if we have any. And would love to connect with you. If you have to jump off, please reach out if there's something we can do. We'd love to help you, even if it's just with some cell phone data, or if you have any questions about certain retailers, we'd be happy to help you out.
Thank you, Austin. We actually did have a question come through. Ricardo asked, is Sports Basement looking at sites under 40,000 square feet? And what about Target looking at smaller concepts in suburban markets?
Yep, they actually both are. So Sportsman's Basement, I believe, is starting to consider concepts in the 30,000 square foot range. And I've heard even lower. I haven't seen that yet, but that's a great example of one that's right sizing and looking at smaller footprints. And then Target, we've talked to them recently about what they're looking for, and they're actually looking at a smaller footprint in urban markets, but they're also starting to look at some more rural opportunities. They've got a smaller footprint that's in the 80,000-90,000 square foot range that they're starting to really look at kind of mid markets or more rural markets that they hadn't considered before. One of the things that they're looking for in those rural markets is more trade area draw, looking at kind of regional trade area draw and opportunities to capture larger regions. But they are considering sites that they really wouldn't have in the last 5-10 years. And from a square footage percentage or perspective, they're definitely looking at things in that 90,000 range. And we've actually heard that there may be some smaller concepts coming out of there as well.
Awesome. To wrap things up, overall, as an economic development manager, you've discussed these trends. What can they take away from these trends and then implement it into their own retail recruitment strategy after looking at what we've seen?
Yeah, I think that the most practical, best way to leverage these trends is really understand your market. So if you don't have up-to-date data on your retail trade area, if you're not leveraging that cell phone data to really understand who's in your market, what your market looks like, and where they're leaving when they're leaving the market, really understanding that and having that data for retailers is important. So I would start there. That's really kind of the 1A. The other is focus on where there's opportunities. Every time we hear about the retail world evolving or changing, or how retailers are shifting their concepts, it's always really almost from a negative perspective. But there's a lot of opportunity there across market sizes, whether you're a really small market or you're in a really large market. There's opportunities to capitalize off of some of these shifts, whether it's in consumer behavior or the right sizing from these retailers. So I would focus on, where do we have opportunities within those trends? With some of the right sizing, do we have opportunities for parcels that we've had available that we haven't been able to do anything with, that we can target, some of the bigger retailers? Maybe it's an 1.5 acre site that wouldn't have worked for a full service dining that now is viable. Really taking an inventory of, okay, what do we have available to capture some of those changing trends? And then the other is just engage with your existing retail base and see if, as they're changing their models, whether it's the store model changing, the expansion plan changing, see what they're saying about those changes and how there's opportunities there. Because a lot of times we're seeing not only just the new store expansion be affected by these trends, but some retrograding and seeing retailers come back in and either change a concept, move a concept. So there's really a lot of opportunities in that space where retailers are shifting and evolving, and just knowing the market and then knowing your sites and opportunities to be able to leverage that, I think, is really important.
Absolutely. Does anyone else have any other questions? You're welcome to put them in the chat. If not, you're also welcome to reach out to Austin or myself if you have anything come up after the webinar. You can find our contact information on our website, theretailcoach.com. My email is randerson@theretailcoach, and then Austin's is austin.farmer. Austin, you have anything else for us?
No, happy to be a resource if we can. We're always trying to stay on top of these evolutions and trends as retailers are changing. Got a question about the slides. We'll either by this afternoon or first thing tomorrow morning, we'll send out slides. It's always hard for us to cover very specific data when we're doing these presentations. So there's a lot of additional data that we're bidding in there and some examples of specific retailers. So we'll follow up at some point this afternoon or tomorrow morning with the slides and some of those expanded notes and examples as well.
Absolutely.
And
Well,
then
hey,
one other point, we'll be at the ICSC Western Conference, September 28th through 30th. I know we had some California communities join us today. Would love to meet with you if you're out there. If there's anything that we can do to help you prepare for that, let us know. We're more than happy to be a resource for you if you're getting ready or trying to set meetings up out there.
Awesome. Well, hey, thank you everyone for being here today. We appreciate you joining us, taking some time out of your busy schedule to be with us today. Like we mentioned, if you have any other questions, feel free to reach out to us, and we will get that webinar recording sent out to you.
Yep. Thanks for joining us.
Thanks. Have a great afternoon.
Bye.